Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. We're diving deep into a stack of articles, pulling from sources like CNBC and Reuters, all published on or around today, August 5th, 2025. Our mission today: cut through that noise, deliver the important nuggets of knowledge from the financial world just for you. We've got a really comprehensive deep dive ready. We're spanning the latest shifts in Treasury yields, crucial economic data, all the way to brewing global trade tensions, the surprising new reality for U.S. oil output, and of course, what's truly driving the biggest players in tech.
Indeed. And what's really fascinating here is how interconnected these all are. They might seem like separate headlines, but they're not. We'll be connecting the dots, between global politics, those key economic indicators, corporate performance, really trying to give you that holistic view, a well-informed perspective on what's shaping the financial landscape today. You get the full story, not just sound bites.
Okay, let's kick things off then. Let's unpack this cornerstone. The U.S. Treasury market, we're seeing some, interesting shifts today. What are the key movements we need to understand? And maybe more importantly, what are they telling us about market sentiment right now?
Right. So as of pretty early this morning, 4:15 a.m. Eastern Time, August 5th, the benchmark 10-year Treasury note yield, it inched higher to 4.21%. The 30-year bond was at 4.801%, and the 2-year note climbed a bit to 3.702%. Now, when these yields rise, generally it suggests investors might be anticipating stronger economic growth, which could mean inflation. Or, they could just be demanding a higher return for holding government debt. Maybe they perceive a bit more risk.
That's interesting because, on one hand, you've got bond yields reflecting that outlook, but then a really respected voice like Jeffrey Gundlach seems to be seeing almost the opposite. How do we square that? Is one side missing something, or is it just massive uncertainty?
That's a critical point. Yeah. Gundlach, in a recent interview, the DoubleLine CEO, he stated he believes there will be 2 rate cuts this year, possibly even a third. Why? He points to what he calls substantially weakening data. He also voiced concern about how reliable the current economic data even is, including the inflation figures. Gundlach, he often has these contrarian views, right? He's basically suggesting the market might be, mispricing the Fed's next moves, maybe underestimating the slowdown that he thinks is already happening but isn't fully captured in the official stats. It's a real tug-of-war in interpretation.
And looking ahead, there's a pretty significant data release later today that could really test these different viewpoints, couldn't it?
Absolutely. The U.S. is set to release the ISM non-manufacturing PMI for July. That's basically a key barometer for the health of the services sector, which, is the bulk of the economy. Analysts polled by Reuters, they're forecasting 51.5. Now remember, anything over 50 signals expansion. So 51.5 would show continued, maybe modest growth from 50.8 last month. But an unexpected number here, much higher or lower, that could definitely swing market reactions, could influence the Fed.
Okay, so while we're tracking the U.S. economy's pulse, another big force right now is these escalating global trade tensions. They inevitably feed back into market sentiment. Let's pivot to President Trump's recent, pretty strong statements on tariffs, particularly aimed at India. What's going on there? Why is it making headlines?
Yeah, it's a complex one. Trump threatened to substantially increase tariffs on Indian goods. He even floated a 25% levy plus an additional penalty if India keeps buying Russian oil. This follows India pushing back against criticism from the U.S. and the EU over those Russian oil purchases. So you see this clear intersection of geopolitics, energy policy, and, economic pressure.
And India's response was pretty blunt, wasn't it? They really didn't mince words.
They certainly didn't. The Foreign Ministry put out a statement saying they only started buying oil from Russia after traditional supplies got redirected to Europe, after the 2022 Russia-Ukraine war started. And they pointedly added, quote, "It is revealing that the very nations criticizing India are themselves indulging in trade with Russia." And then they said, unlike our case, such trade is not even a vital national compulsion for them. That's a pretty strong claim of hypocrisy.
Wow. So what do the numbers actually say about that trade? Because India really called them out there. Does the data back them up?
The data is quite illuminating. The EU's bilateral trade with Russia, 67.5 billion euros in goods in 2024. That's significantly more than India's total trade with Russia, which hit a record $68.7 billion for the year ending March 2025. That's almost 5.8 times higher than pre-pandemic levels for India, mind you. And the U.S. itself had $5.2 billion in trade with Russia in 2024, down from $36 billion in 2021, yes, but Notably, the U.S. hasn't imposed reciprocal tariffs on Russia. So, yeah, India does seem to have a statistical leg to stand on there.
And India feels it was actually encouraged to buy Russian oil at one point. That's quite a twist.
Precisely. India stated the U.S. actively encouraged such imports by India for strengthening global energy market stability. They even quote a former U.S. ambassador to India saying, "We wanted somebody to buy Russian oil," so that really complicates the narrative. India's former finance secretary even suggested India should just let the threatened 25% tariff happen. Why? Reasoning that American consumers would end up bearing the cost anyway, shifting the burden back. It's a high-stakes game.
Okay, shifting over to the EU then, we're seeing some movement there regarding U.S. tariffs. It sounds like a bit of a mixed bag. Some relief, but still uncertainty.
That's a good way to put it. The EU is going to suspend its planned U.S. tariffs for 6 months. Gives them more time to negotiate, finalize a joint statement on their trade deal. It's not exactly cause for celebration in the EU, but it's definitely seen as a sense of relief, a temporary pause in hostilities. The U.S.'s 15% tariff on EU goods is described as all-inclusive, although tariffs on cars and car parts are expected to drop soon to 15% from 27.5%, but the EU is still pushing for zero-for-zero exemptions on essential products. So the negotiations aren't over.
All right, let's pivot now to the energy sector, specifically U.S. oil production. It sounds like it's facing a pretty significant, maybe unexpected challenge, broader implications.
Yeah, if you connect this to the bigger picture, the sliding number of oil and gas rigs here in the U.S., it's now actually outpacing the efficiency gains we've seen. And that's threatening onshore crude output. This isn't just a small dip, it could be a fundamental shift. I mean, current output jumped to 13.5 million barrels per day with only 540 rigs. That's compared to, 12.14 million BPD with over 1,000 rigs back in April 2019. Huge efficiency gains there. But despite that, analysts are now forecasting a decline. It really highlights a potential tipping point for U.S. energy.
So wait, despite all those incredible efficiency gains we've heard so much about, we're at a point where that's just not enough anymore. That feels huge, given the U.S. role as a top producer.
That's precisely it. Wood Mackenzie analysts. They expect lower 48 oil output to fall by 200,000 barrels per day next year, and then another 130,000 BPD decline in 2027. Novi Labs forecasts an even bigger drop, 400,000 BPD, by the end of next year. The U.S. Energy Information Administration, the EIA, also points to lower crude prices driving this expected downturn. If this holds, you could see higher global oil prices, maybe renewed energy security concerns, potentially more pressure on consumers. A real wake-up call.
And the Permian Basin, that crucial area for U.S. production, seems particularly affected. Is this where it's really hitting home?
It is. The Permian has seen 24 rigs dropped just in 10 weeks since May. Lower oil prices are the culprit. Paul Mosvold from Scandrel, he explained it well. He said the big efficiency gains came from upgrading to bigger rigs. But now, there are no bigger rigs left to upgrade to, so what's left is just incremental tweaking. And that tweaking, it just won't give you the same level of improvement, the same production boost we saw before. It's like the industry squeezed out all the gains from the current tech. Now it needs more rigs in the ground.
So the sheer number of rigs is becoming the dominant factor again. It's not just about drilling smarter, it's about drilling more. That feels like a big strategic shift.
Exactly. Brandon Myers at Novi Labs highlighted this. He said, yeah, there's been maybe a 25% improvement in rig efficiency over the last few years, but the rig count itself has fallen over 30% in that same period. And he says, quote, "Put simply, the rig count declines have begun to outpace drilling efficiency gains. This is a recent development. It really underscores that relying only on efficiency isn't working anymore to offset the shrinking rig count. Changes the whole calculation."
And what about the quality of the wells themselves? Are they just drilling in less good spots now, or is something else going on?
Well, Morgan Stanley analysts reported something interesting there. Oil per foot drilled in the Permian's Midland and Delaware subbasins. It actually fell 8% so far in 2025 compared to last year's average. That suggests, yeah, maybe a degradation in well productivity. Even new wells might not be yielding as much. Jesse Jones from Energy Aspects, he anticipates Permian production falling by 150,000 BPD in 2026. He also noted that the really high-quality inventory, the best spots that were available in 2020, they just don't exist in the same quantity anymore. And remember, production declines from rig count changes usually take 6 to 9 months to show up, so we're probably just starting to see the effects.
Okay, let's shift gears now, over to the tech world. Despite these broader economic worries, the energy challenges, the market seems incredibly resilient. And it seems like it's largely thanks to a few familiar, very big names. Quite a divergence from other sectors, isn't it?
That's certainly true. Jim Cramer pointed this out. He attributed much of Monday's market rebound to positive news from the Magnificent Seven. You know them: Microsoft, Meta, Amazon, Apple, Alphabet, Nvidia, and Tesla. These companies are just powering earnings growth. Their year-on-year earnings, up 26%. Compare that to a combined 4% growth for the rest of the S&P 500. It's stark. It speaks to their huge cash reserves, their multiple revenue streams, keeping expenses tight. Honestly, these companies operate with such financial clout. Their performance really ripples through the whole global economy. Their earnings reports are almost like geopolitical events.
Speaking of strong performers, Palantir. Wow. Stellar quarter. What should our listener know about that? They really blew past expectations.
They absolutely did. Palantir topped Wall Street's expectations, hit $1 billion in quarterly revenue for the first time ever. Analysts didn't think they'd hit that until Q4, so way ahead of schedule. Revenue grew 48% year over year, huge number. And what's fascinating is the surge in U.S. revenues, up 68%. U.S. government revenues jumped 53%, and U.S. commercial revenues nearly doubled. It's really a testament to the booming demand for their AI and data tools, both public and private sectors here in the U.S.
And they sealed that massive deal with the Army.
Yeah.
Right? That sounds like a real game changer for their government business.
Yes, a huge one. A 10-year, $10 billion software and data contract with the U.S. Army consolidates multiple older contracts into one big one. CEO Alex Karp highlighted the, quote, astonishing impact of AI on their business and their drive for a crazy efficient revolution. He's aiming for 10x revenue with fewer people, which is ambitious. Now, while this is all incredibly impressive, you have to look at the valuation. Their shares trade at 276 times forward earnings. That's an extraordinary multiple. Investors aren't just betting on good growth. They're pricing in monumental, sustained growth for years. Very high stakes.
Okay, on the other side of that coin then, TSMC, the world's biggest chip maker, facing some concerning news, could have wider implications for the supply chain. What's the scoop?
Yeah, this really brings that whole issue of intellectual property protection into sharp focus, especially in such a competitive field. TSMC announced they detected unauthorized activities, potential trade secret leaks, specifically linked to their cutting-edge 2-nanometer chip development. That's next-gen stuff. They've taken strict disciplinary action, launched legal proceedings, and this isn't their first time dealing with this. They had similar issues back in 2018 and 2023. It just underscores how strategically vital semiconductors are for AI and the intense geopolitical tensions around developing and controlling them. It's a constant battle.
And this affects partners too, right? Like Hon Hai, NVIDIA's main server assembly partner. How does this IP issue and the trade tensions trickle down?
It certainly does. Hon Hai's July sales growth slowed down, 7.25%. That's its slowest pace since January. It signals that these tariff-induced uncertainties are starting to affect electronics demand across the board. This comes as President Trump set that 20% levy on Taiwan exports. Plus, there's a U.S. investigation into semiconductor products that could hit them further. But despite all these headwinds, Hon Hai is strategically expanding its AI server assembly capacity in the U.S., trying to navigate these shifting sands by diversifying where they operate.
Right. And finally, speaking of those critical chips and the high-stakes geopolitics around them, another major player is making big moves, SoftBank. Seems like they're really doubling down on AI hardware.
They are. SoftBank is increasing its stakes in both NVIDIA and TSMC. It reflects Masayoshi Son's intense focus on the foundational tools, the building blocks that underpin AI. He famously called NVIDIA the picks and shovels for the gold rush of AI. That's a powerful analogy, right? Identifying the key enablers. His broader strategy really revolves around the chip designer ARM Holdings, which SoftBank controls. And Son is actively leveraging his relationship with Donald Trump as AI and semiconductors become these critical geopolitical flashpoints. It's a strategic play to be right at the heart of the AI revolution, especially as we see the U.S. exploring ways to track chips better, trying to limit flow to China. And Beijing's already calling in NVIDIA reps. High stakes indeed.
Let's do a quick check-in on the Eurozone economy. What's the latest there? Are we seeing any strong signs of recovery? We're still sluggish?
Well, business activity in the Eurozone did inch up slightly in July. The composite PMI hit 50.9. That's a 4-month high. But overall growth remained pretty subdued. Demand dipped. While Italy, Spain, and Germany saw some growth, France was the only major economy to contract. Again, for the 11th straight month. That indicates persistent weakness there. Job creation was modest, though it was the fastest in over a year. And easing cost pressures in services suggests there's a likelihood of another ECB rate cut this year. So some very small pockets of improvement maybe, but still largely a slow grind for the region.
Okay. And for our listener interested in specific stock insights, Jim Cramer had his lightning round. Any key takeaways? Any buy or sell signals maybe?
Right, Kramer. known for his rapid-fire takes. He had some notable calls. He said, buy, buy, buy for Tesla. His view, it's transitioning from just a car company to more of a technology company, highlighting AI, software. He also liked Snowflake, said you can buy more. So continued confidence in cloud data warehousing. However, he was wary of Accenture, said he couldn't get behind it, citing poor performance. Concerns about their consulting business, maybe. He wouldn't recommend Ford either. Pointed to ongoing warranty issues, which could really drag on earnings. He also mentioned, interestingly, that the S&P Industrials are the second best performing sector year to date. Suggests underlying strength in names like Caterpillar, Jacobs Solutions, Cummins, and AMD, also trading just off its 52-week high. So strong performance there in chips alongside NVIDIA.
So wrapping this all up, what does this mean for you as you navigate today's financial landscape? From that delicate balance of global trade, the surprising dynamics in U.S. oil, the unstoppable rise of AI, understanding how these stories connect is really key to being well-informed.
Yeah, it really highlights that crucial question, doesn't it? How do you assess risk? How do you find opportunity when so many different factors, political rhetoric, tech breakthroughs, are moving markets in ways you might not expect? It really underscores why you need to look beyond just the individual headlines. You need to grasp the full implications, try to anticipate where the next shifts might come from, understand that intricate dance between all these global forces.
Absolutely. We hope this deep dive gave you that vital context, maybe a few aha moments along the way. Remember, staying curious, connecting those dots. That's probably your best shortcut to knowledge in this environment. That's all for our deep dive today. We'll see you all tomorrow morning with new headlines from major financial magazines.